Hi everyone, this is Prashad Parthiban. Today I'm going to take a quick training on crime insurance. First and foremost, let's see why do you need crime insurance. Lines of business like commercial property or general liability, they don't cover all possible loss exposures. So in those scenarios, we need extra or additional lines of business to cover those missing loss exposures that are excluded in either commercial property or general liability. So one of them is crime insurance. So what are the loss exposures that crime insurance is going to cover, which is excluded in either commercial property or general liability? The first one is employee theft. If you have a company and if your employees are going to involve in malpractice and going to take away some of your properties illegally, then you can use this coverage, employee theft coverage under crime insurance. The second one is forgery or alterations. So if you as a company, you are giving a check to your end customer and somebody who's working as an intermediary like a broker, they do some kind of forgery and alterations, then you can use this coverage, forgery or alterations. Third one is inside the premises theft of money and securities. If somebody is going to take away your company money and the securities is nothing but kind of contract that is equivalent to your money, then you can use this particular coverage. The fourth loss exposure is inside the premises robbery or safe burglary. So if you have a company, if say like you are having a stationery shop, if somebody like a customer who taken away some products and ran away without paying your bill, then you can use this particular coverage. Outside the premises, sometimes what happens is you are taking your products or money or securities in your uh, commercials commercial autos and somebody try to take away your monies, then you can use this outside the premises coverage. The sixth one is computer and funds transfer fraud. Nowadays we see this a lot. Somebody try to hack your computer and they try to transfer some kind of fund from your company, then you can use computer and funds transfer fraud. Money orders and counterfeit money, like same thing, like you get a money order from your post office and then somebody who's representing your company is trying to uh, do some kind of forgery on the money order and trying to pay your end customers. In those scenarios you can use money order and counterfeit money. So these are the high level possible loss exposures that is covered under crime insurance. Now there are two ways you can kind of get your crime insurance. One is discovery form. The second one is loss sustained form. The name itself is going to explain about these forms. When you say discovery, it's nothing but form that cover losses discovered during the policy period, even though they may have occurred before the policy period, which means this particular form will be used in such a way that whenever you discover the loss, that's the time the insurance company is going to pay, irrespective of when the loss occurred. If you see this example, we have four terms for a particular policy. Term 1 starts on January 2019, and term 2 starts on January 2020, and term 3 starts on January 2021, and term 4 starts on January 2022. Now, what happens is, during January 2022, you discovered a loss that happened on January 2019, which is 4 years prior to your discovery date. Because of the fact you are using discovery form as per the definition of discovery form, whenever you discover the loss, that's where the insurance company is going to pay. Because of the fact you discovered during January 2022, irrespective of when the loss occurred, the insurance company is going to pay because you have selected discovery form. If you see loss sustained form, as per the definition, form that covers losses actually sustained during the policy period. If you closely watch here, this second form is going to pay more attention towards when the loss occurred compared to when we discovered the loss, and discovered no later than 1 year after the policy expiration. So if you see this example, you have term 1 starts on January 2019, term 2 starts on January 2020, term 3 starts on January 2029, where the loss occurred. Now, as per this definition, this particular form is going to be based on when the loss actually occurred, and then the discovery should be no later than 1 year. So in this case, if the loss occurred during January 2021, and you discovered during June 2022, which is a valid scenario, then the insurance company from term 3 will pay you the losses. Imagine the case you had a loss on January 2021, whereas you found or discovered the losses only during January 2023, then the insurance company will not pay you the losses because the loss was discovered later, greater than 1 year. So that's the difference between discovery form and loss sustained form. I hope you like my training videos. If you like my training videos, please do subscribe to my YouTube channel. Have a great day. Bye bye.